The stock market has its ups and downs, and currently we're in one of those down moments where almost any company out there is on a dip. Some companies are on bigger dips than others, and some companies that rarely ever see their stock price dip have caved in and dipped in the last week. And what I really want to focus on in this month's video for 3 stocks to buy is 3 high quality premium companies that rarely see their stock price dip. However, with the correction last week, they did cave in and they did come down. And when I say came down, I mean these companies are down 20% or more from their highs. So what I'm going to do is start off with the company that's down the least, which is 20%, move on to our second company, which is down around 24%, and then finally our third company, which is down 26%. But keep in mind that all 3 of these businesses are incredibly valuable brands, incredibly sought after businesses that rarely see their stock price dip. So I think this may be an opportunity for us to take advantage of their stock price dropping. As always, guys, remember to smash that like button down below. If you're standing strong here beside me through this market correction, let's try to get 500 likes on this video. Also, make sure to stick around until the end of this video where I kind of compare these 3 stocks on a fundamental level here and kind of quickly go over high level as to why I feel they're undervalued. And I also have a special challenge set up for you guys at the end of this video, so stay tuned for that. So let's start off with our first stock, which is down 20% from its highs. Now, if you're a longtime viewer of this channel, you know that I have mentioned JPMorgan Chase many times whenever we have discussed financial stocks or companies that I'd like to own one day. During the 2018 correction, I missed my opportunity to get into JPM, and I've waited patiently for the last year for the stock to present another opportunity for me. Well, this past week, we have come back down to prices that make this company just too tempting to pass up on, and allow me to explain why. JPM is the largest bank in America with a market cap near $375 billion, making it also one of the largest companies in the world. They have an incredible CEO who has really embraced technology and has made decisions over the years that has helped JPM become what it is today. Over the last decade, this company has become a powerhouse, and in recent years, their growth has accelerated. Revenue is up significantly, operating income is up, and net income is up, all signs that this is a healthy growing business with strong fundamentals behind it. Adding to this, JPMorgan Chase is also a dividend stock, yielding over 3% currently with an extremely low payout ratio of 33% and a 5-year growth rate of over 16%. This is a company that is well positioned to reward shareholders over the coming years, not only with capital appreciation after the stock price recovers from this dip, but also in the form of dividends, which I believe will keep growing every year. TipRanks shows a fairly high amount of upside from current prices, so analysts in general tend to agree that the stock should be worth around 25% higher than it is today. Keep in mind that in January, we did hit a peak of $141 a share in JPMorgan Chase, so it's not that unrealistic to see the stock back up to those levels over time if these fundamentals continue to grow. Now, speaking of the charts, let's take a look at JPMorgan here. This is the weekly view, and what we see, like I mentioned earlier, is that it's down 20% from its highs just this past week, and this has brought us down to around the 100 moving average on the stock. Previously, back in 2018, we saw it correct around 24%, and it also came down to this level back then, actually a little bit below it. But shortly after that, we bounced back and recovered. This could happen again, or it could take some time for it to recover. But either way, I believe the value we're seeing here in this stock at under $120 per share is one I wouldn't want to pass up on. So let's move on to our second stock here, which is down around 24% from its highs. Starbucks is a company that I'm not sure we've covered much on the channel, but it's been a stock that I've had a close eye on for many, many years. Even though we're not quite at prices we were at a year ago, this is a company that demands a premium valuation because it is growing quite rapidly. Now, there's only a handful of stocks that I would ever consider owning in this sector, and Starbucks tops the list because they do things right. They have built a strong brand, they have a loyal customer base, and they are a worldwide company, which gives me good diversity outside the US should we enter any sort of recession. Here we can see where Starbucks sits in a chart that compares the most valuable fast food brands in the world, and it's second only to McDonald's, and that also by a huge margin. And as you guys know, McDonald's is another business that I absolutely love as well. Starbucks is also the #1 coffee chain in the US, holding a good chunk of the market here. Along with this, they have incredible fundamentals, and you can see how well their revenue has been growing every year. Their operating income and net income is also growing, although not as quickly, but they are investing heavily in China and other parts of the world. Over time, I think these investments will pay off pretty well for them, and it'll result in higher profits for the business. The revenue growth gives me confidence that this is a fast-growing business and that the market cap of around $90 billion currently is one that I think has a lot of room to grow over time. Now, like JP Morgan Chase, Starbucks also pays out a dividend. They currently pay out over a 2% yield, and their payout ratio is a respectable 55%, which gives it a lot more room to grow over time when the revenue growth slows down, but they still want to reward shareholders. But even with their business as a whole growing, they have been hiking this dividend on average by a whopping 22%, making this one of the fastest dividend growth companies out there. This really gives investors another reason to hold this stock long term. Now, analysts on TipRanks see around a 21% upside from current prices, which in my opinion is modest, especially if we keep growing at the rate we have seen over the last few years. In fact, very recently, we almost hit $100 per share in the stock before we saw a pullback, which has now resulted in about a 24% dip from its highs. We can see here that it brought us to around the 100 moving average in the stock, something it hasn't done since mid-2018. And really in mid-2018 was when I was debating getting into Starbucks when it dropped under $50 per share. But I'll be first to admit that I missed my opportunity there. So I will definitely not let another drop like this in the stock pass me up so easily once again. Maybe we see prices below $70 per share, maybe not. But either way, I'm happy with the value that I'm seeing right now in Starbucks. And in the $70 range, I think the stock is a strong buy. So we've covered two solid businesses that quite honestly I would hold forever in my portfolio. And this third company is no different, especially after it's seen a 26% haircut in recent weeks. Good old Disney is one of the most iconic companies in the world, and the stock did have quite a bit of news this past week. Apart from the stock dropping back to levels it was at before the Disney Plus announcement, we also had a big shift in their executive team. This came as a surprise, but Bob Iger, who was the CEO of Disney, stepped down as CEO this past week out of nowhere. However, he will remain as executive chairman until 2021. After this announcement, he said that he wants to essentially focus more on the creative side of the business, and by stepping down as CEO, it frees up more time for him to pursue this. It doesn't appear to be some conflict between the business and Iger that resulted in him stepping down, because like I said, he's still going to remain the chairman until 2021. Iger was really an instrumental part of bringing Disney to where it is today, with important decisions like acquiring Pixar and Marvel in his early years as CEO, and then buying Lucasfilms and Fox in more recent years. And of course, most recently, as a lot of you know, he was involved in bringing us Disney Plus, which is kind of the next saga for this well-respected business. And honestly, this news couldn't have come at a better time in my opinion, because Disney just dropped like every other stock out there in the market this last week. Maybe the correction in Disney would have been around 10 to 15% if it was just purely this news and the market was still moving higher. However, it is what it is. We got a good discount here in Disney, and it's providing us some incredible value right now. Now here is Disney's fundamentals over the last few years, and in general, everything is trending higher and stronger. Of course, in the most recent year, we're going to see things like free cash flow drop. That's because of heavy investments in Disney Plus. We can clearly see here that the revenue that the company is bringing in hit a new record in 2019, and this is before Disney Plus really had a full quarter to acquire subscribers. Now, Disney is also a dividend company like Starbucks and JP Morgan Chase with a current yield of 1.5%. However, when you look at their growth potential here for the business, it's actually a nice little bonus. They currently pay out about 33% of their earnings in dividends, similar to JP Morgan Chase. However, their growth rate is slower at around 9%. Analysts see over a 35% upside in Disney stock from current prices, and this is very reasonable in my opinion. If you consider the amount of growth the company has shown it can do and the growth it's expected to do over the next few years, this stock is undervalued. Clearly, the charts here show us that Disney was hit hard, dropping to its 200 moving average on the weekly, and is bringing us back to prices that were technically seen in 2015. So you're getting a business here that has essentially increased their net income nearly 25% since 2015 at prices that we saw in 2015. So you tell me that that's not a bargain. I, for one, absolutely love this business, and I even covered this in a video that I made last year saying that my top stock pick for 2019 was Disney. And of course, as we saw throughout the year, 2019 was one of their best performing years ever. And honestly, even though the news about Bob Iger stepping down was kind of hard for a lot of investors to take, I personally love him as a CEO. I think that the next real saga in this company with the whole streaming game does provide a lot of value, and Bob has really set this company up for success moving forward, so I really don't have concerns owning this company over the long term. I think that they're actually going to be a huge force to reckon with, even with large established companies in this space like Netflix, or even companies like Apple and Amazon entering the space. I think that Disney, with their content and their brands behind it, will actually be a very close second, if not first, if not first, when it comes to streaming. Now, here in summary is where the three businesses sit today. JP Morgan Chase and Starbucks are clearly undervalued on a forward PE basis, and on a dividend basis, they are also showing us value here. So when I did my analysis and looked at stocks from March 2020, these companies both popped up as incredible value. Now, if you're unsure how I figured out if a stock is undervalued based on its dividend yield, make sure to check out my video on that, which I'll leave a link in the description down below. Now, Disney is an interesting one because based on its historical PE, it appears overvalued. However, based on the dividend yield valuation, it's undervalued. Now, one thing you need to understand is that fundamentally, Disney is a different company today than it has been historically because it competes in things like streaming, which makes it more like a tech type company. And because of this, I believe that there should be somewhat of a premium on the PE of the stock based on its historical valuation. This is why I think that even though there's a PE of 19 currently on Disney, if we look at the business like Netflix, for example, which does only streaming, they're trading at a forward PE of 44. So to get Disney, which is most likely going to compete head-to-head here with Netflix over time with number of subscribers and revenue, at a PE of 19, and you also have this business with so many other growth segments like their parks and all that kind of stuff, this is an absolute steal. My belief is that analysts are actually underestimating the success of Disney Plus, and soon enough we'll see the stock trading at a mid to high 20s PE in my opinion. All we really need to do is just give ourselves some time here for the numbers to play out, for analysts to come around and realize Disney Plus is a big force to be reckoned with. Alright guys, so as you know, the market has presented us a real gift here, a real opportunity over this past week. And like I said, there are just too many companies on sale here, and I really wanted to go through and comb through three premium type companies that rarely go on sale here in the stock market. And I'll tell you what, as a special challenge for this video only, if you guys can hit 750 likes before the end of this week on this video, I will create a video on 3 more stocks that I believe are extremely undervalued, that I think are also great buys for March 2020. So guys, I really enjoyed making the video this month because we're seeing so much value out there, and it's just exciting to see these awesome companies at awesome valuations after waiting for so long for prices to come back down. Now, I'd love to hear your thoughts on all the companies that we covered today, JP Morgan Chase, Starbucks, and Disney. Let me know if you own any of these companies down below. And if you do, did you buy any stock last week in these companies, or are you planning to buy some this week? I'd love to hear your thoughts in the comment section down below. Also, don't forget to check out the description for a couple other videos that you may be interested in watching as well. Guys, thank you so much for watching. Don't forget to invest positively. I appreciate you sticking through to the end of this video here, but either way, I'll see you in the next one. Peace.